Hello everybody, and welcome to School of Stock. I'm Girk, and for this lesson, I want to cover options contracts, just the very basics. What is an equity option? What does it represent? I want to cover the difference between calls and put contracts, clarify terms like in the money, at the money, and out of the money, take a look at and define the different parts of an options quote, and finally finish up with some examples of long options positions both on the put and call side. So welcome to Options, Part 1. A smooth brain guide to one of the most complicated investment vehicles. Let's talk first about what is an options contract. Options are a financial instrument that are based on the value of underlying securities such as stocks. An options contract grants the right, but not the obligation, to the purchaser of the contract to buy or sell the underlying asset at an agreed upon price, known as the strike, and by an agreed upon date, known as the expiration. Options are the basis for a wide array of strategies designed for hedging, protecting investments, income, options can be sold to generate income, and speculation, essentially betting on the outcome of a move in a stock or other asset. Options are a form of leverage. One contract represents 100 shares. There are two types of options contracts, the call and the put. Puts and calls can either be sold, known as a short position, or bought, known as a long position. The call option is generally purchased in the hopes that the underlying will increase in price. A call buyer has the right, but again, not the obligation, to buy 100 shares at the strike price. They have the right to call away or take back shares from the seller. A call seller has the obligation to sell 100 shares at the strike price if the buyer invokes their right. A put option is generally a bet placed to the downside. A put buyer has the right, but not the obligation, to sell 100 shares at the agreed upon strike. The right to put shares on to the seller. A put seller has the obligation to buy 100 shares at the strike price if the buyer invokes their right. Let's define some terms known as in the money, at the money, and out of the money, commonly abbreviated as ITM, ATM, and OTM. This is what an options chain looks like. You will see on the left strikes, you will see calls and puts. In this example, our current market price for the underlying stock is $85. This is known as at the money. So, stock XYZ is now trading at a market price of $85. In the money, or ITM, means the strike of the option is below the call or above on the put the current trading price. At the money, the strike of the option is at the current trading price. And out of the money, the strike of the option is above the current trading price if a call, and below the current trading price if a put. Now let's take a look at the anatomy of an option quote. These will vary from broker to broker, but will always contain these 5 key elements. The first up being the ticker. This is the CUSIP ID of the stock that you intend to trade. Next will be the expiration date. This is the date on which the options contract expires or must be exercised by. Then we have the strike. This is the agreed upon price for the contract. Then it will define whether it is a call or a put. Sometimes it will say call or put. Sometimes it will be listed with a C or a P. And in a few occasions, it will be color coded green for call, red for put. Finally, the premium. This is the price you pay to buy to open the contract. So let's take a look at a long call example. Stock XYZ is trading at $90. The call buyer, expecting the price of the stock to rise, buys a call option that has 30 days till expiration at an out of the money strike of $95. Here's that quote. As you can see here, since the market price is $90, this contract is out of the money. It is a call. This will be its expiration date. This its ticker. And this will be the premium for the contract. Now, I know you're thinking, wow, 22 cents, that's really cheap. But remember, an options contract represents 100 shares. So this is the price times 100. So the actual out-of-pocket expense to purchase this contract will be $22. After 5 trading days, the price of the stock rises to $100, making the new quote the same, except as you can see, the premium has risen. Now that the call is in the money, because the price is $100 and the strike is $95, the call buyer may either exercise their right to call away their shares or sell to close the contract, sometimes known as taking profit. If the buyer chooses to exercise by calling away 100 shares from the seller, they will pay $9,500, the strike times 100 shares, plus the initial $22 premium already paid, for a total of $9,522 to obtain 100 shares of the underlying stock, now trading at a market price of $100. If they choose to sell to close or take profit, they can sell the contract for the premium of $5.45 times 100, or $545, making a 2,377% profit off an initial investment of only $22. Now let's take an example of a long put. Stock XYZ is trading at $90. The put buyer, expecting the price of the stock to drop, buys a put option that has 30 days till expiration, or 30 DTE, at an out of the money strike of $85. Remember, for puts, if the strike is below the current trading price, it is considered out of the money. Here's an example of that quote. Stock XYZ, the expiration, an $85 strike, it's a put, and its premium is 14 cents. Remember, times 100, so $14 to buy this contract. After 5 trading days, the price of the stock drops to $80, making the new quote, stock XYZ with an expiration and $85 strike. But as you can see, the value of the contract, or the premium, has gone up by 3,421%. This was a directional bet, and the stock moved in the direction of that bet. Now that the put is in the money, the put buyer may either exercise or sell to close, take profits from their contract. If they choose to exercise by putting 100 shares on the seller, that allows them to sell 100 shares at the strike of $85. minus their initial $14 premium, for a total of $8,486. Now with a put, they already need to own those shares, or they need to purchase them at the current market price of $80 a share. If they choose to sell to close or take profit from their contract, they can sell it for a premium value of $493 or $4.93 times 100, making a 3,421% profit off their initial investment of $14. Here's a few more things you should know about options contracts. Most stock options come from the Options Clearing Corporation, or OCC. They ensure that every transaction has a buyer and a seller, and the market remains liquid. Market makers are tasked with assisting in creating this liquidity. The premium price of an option is always the per share price. Since options represent 100 shares, the premium is always multiplied by 100. Example, a premium of $1.21 is in fact $121 after it's multiplied by the number of shares the contract represents. A stock option does not grant ownership of anything. However, the contract does grant certain executable and enforceable rights. The most that you can lose on a long call or put position, like in our previous examples, is the initial amount invested, or the premium. So if you buy a call for $2.20 or $220, that is your maximum loss on the position. I think that'll about do it for our introduction to options. This is a complex subject, and there will be many, many more videos on this topic coming out in the future. For the meantime, I want to break it down into small, digestible bits that people can easily understand. If you guys could, please drop a like and a subscribe. It's a huge help to the channel and a great way to show your support. And if there's anything you want to see us discuss on this channel, or any questions you have about this video, please leave a comment down below in the description. Thank you so much.